I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the final video on chart basics and price action. I will be talking about candlestick patterns. I will talk about what traders talk about. And finally, I will talk some about indicators. I think one of the unfortunate things that beginners see when they start out is a collection of ads and claims on the internet and in books and magazines that make it sound like if you simply memorize a handful of candlestick patterns, you're going to get rich. And it's really deceiving because there's nothing easy in trading. You're competing against the smartest people in the world who are working extremely hard, and they are not going to give up their money easily. So if you see ads like this that tell you that you can make an incredible amount of money with minimum work, for example, this one says you can turn $250 into $34,000 completely on autopilot. It's really tempting. Everyone starting out is looking for protection. They're afraid of losing their money. They're looking for someone who's going to take care of them, but nobody's going to take care of them. They're looking for some easy way to make money that's guaranteed to not lose money. And all of the ads imply that all you have to do is memorize a few candlestick patterns, and they'll work all the time, or they'll work 90% of the time, and you'll soon be rich like everybody else, like Warren Buffett. But that's not real. It's just not real. It's misleading. So whenever you see anything like this, just ignore it. Move on to something else. Now, you correctly believe that there are institutions that make a lot of money. There are high-frequency trading firms, HFT firms, hedge funds, Goldman Sachs. Most of the firms that are out there making a lot of money are not making them based upon candlestick patterns. And if candlestick patterns were the key to wealth, everyone would be using them to make money. But that's not the reality. Lots of successful day traders talk about their trades. For example, if you watch Fast Money, a television show on CNBC, you'll listen to the traders talk constantly about trends, channels, prior highs, prior lows, support and resistance, and you'll never hear them say anything about a particular candlestick pattern, like, oh, I sold because of a dark cloud cover, a shooting star, or a Harami pattern. They don't talk about that because that is such a tiny part of trading that it's not going to make you any money. You have to learn far more than that to be successful. Now look at this. Here's a candlestick bottom. The market's going down, tries to bottom again. Can you make money from this candlestick pattern? Of course you can. The way to do it is you don't buy, you wait for a few bars. And then you sell where the bulls will get out. The bulls are trying to buy a bottom. Trends are resistant to change. They're probably going to continue. The bulls who buy here are going to get trapped and lose money. So rather than buy here, look to sell where they'll get out, where they'll get stopped out. So yes, you can make money trading a candlestick pattern, doing the opposite of what conventional candlestick pattern teaches you to do. Look at this. Here we have a bearish engulfing top on the daily chart. The textbooks would tell you, this bar traded above the high of that bar, and then it closed on its low, and it's a big bear bar closing on its low. It's a short. It's a short. Well, the risk is not all that great. It's to this point. The reward, maybe we come all the way down here. That's good too. So great risk reward. However, what about probability? 80% of reversal attempts fail. So this failed, this failed, this failed, this failed, this failed, failed. This one looks better than the others, but is it going to succeed? No, whenever you see a top, you have to expect that the top will fail and become a bull flag. Don't be too quick to sell a top. Instead, you have a better chance of making money if you wait a few bars for the top to fail and become a bull flag, and then buy as the trend resumes up. Look at this. Here we have a bullish engulfing bar. It traded below the lows of all of these bars and then reversed up strongly and closed on its high. But you need context. Context means you have to look at all the bars to the left, and they have to support your trade. Now look at these bars to the left. A very tight bear channel with very little in terms of pullbacks along the way. What is the probability that the first reversal up is going to lead to a bull trend? The probability is very low, yet you have a great looking candlestick pattern. But the candlestick pattern alone is not enough. It has to be in a context that makes sense, and this does not make sense. This is a low probability trade. So what do? Well, the candlestick guys are buying, betting on the trend reversal, but the smart guys are saying, it's just a pullback in a bear trend, and therefore it'll fail and become a bear flag. What they do is they don't buy here. They place a sell stop to go short below the bear bar that followed it, betting that, like most reversals, this one will fail and the bear trend will continue. Markets have inertia. That means they are resistant to change. And there's an 80% chance that they'll continue doing what they have been doing. So, for example, if you want to know what the bars to the right look like, the ones that you don't see yet, look to the left. If we're in a bear trend, chances are we're going to continue in a bear trend. And if we're in a trading range, chances are we'll continue in a trading range. There's much more to a bottom than simply a candlestick pattern. So if you're in a bear trend, you make more money expecting reversals to fail. You know, we had lots of reversals here, 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 here. And we tried to reverse here and here, here. Most reversals are going to fail. Every one of those reversals is minor. They are not major trend reversals. They are not going to change a bear trend into a bull trend. They're going to change a bear trend into a bear flag, and then the bear flag will lead to a resumption of the bear trend. My 80% rule, inertia. When the market's in a trend, 80% of reversal attempts will fail. They're minor reversals, and they become bear flags, and they lead to resumption of the trend down. So for example, here, we're trying to reverse up. We have a small double bottom. Am I going to buy that bar? No. If anything, I'm going to place a limit order to sell at the high of the bar. Same here. Here's a bull bar closing on its high. Am I going to buy that close? No. If anything, I'm going to place a market order to sell as soon as I see that big bull bar attempting to reverse up, because I know the math is it's more likely to lead to resumption down. And that's true all the way down. Every one of the reversal attempts I'm viewing as a bear flag, and I'm looking to sell. Bulls finally got their bounce. The bulls who have been buying all the way down finally made money, but they lost money on all the other prior attempts, and what they make here will probably not be enough to offset their prior losses. And even this is only a minor reversal. When the channel is this tight, you might bounce for 10 or 20 bars, but the odds are you're going to come back down and test this low. At that point, you might get a major reversal, but all of these reversals, including this one, is probably minor. Now, my 80% rule also applies to trading ranges. In a trend, 80% of reversal attempts fail. In a trading range, 80% of attempts to break out into a trend will fail. So we tried to go to a new high, it reversed down. A new low, reversed up. New low, reversed up. New high, reversed down. New low, reversed up. New high, reversed down. If you see a market having a lot of trading range, price action, don't get excited when it breaks to the downside. You have to assume the downside breakout will fail, and don't get excited when it breaks to the upside. Even when it's breaking strongly to the upside like this, the odds are that it will fail, at least pull back a little. Here it pulled back all the way to a new low. You know, trading it's difficult to do. I've been trading for 30 years, and it's still difficult, but I enjoy doing it, and I'm very peaceful when I do it. When traders start out, they quickly learn that they lose money. You know, no matter how hard they try to trade really well, no matter how much they know about candlestick patterns, they're losing money. So they realize they're missing something. For example, here, a sell, but the market keeps going up. You know, what they're missing is understanding context. And context means all of the bars to the left. And what the market has been doing prior to the current bar is far more important to what the current bar looks like. Candlestick patterns alone are useless. And if anything, when you're starting out, you'll lose money because you'll constantly be betting that trends will reverse, and you'll constantly be betting that trading ranges will break out. And 80% of the time, you're wrong. You're taking 20% bets, and it's virtually impossible to be making money if you win only 20% of the time. After traders lose enough money, they start to look for help. They're desperate to believe in anything, and there are lots of well-intentioned people out there who want to help you, but a lot of them are dishonest, and a lot of them teach you that knowing candlestick patterns is the only road to making a fortune as a trader, and that's simply not the case. Here, good bull reversal bar, buy. No, you don't buy. It's following 3 bear bars. Look to the left. The market's going down. So if anything, you're looking to sell. So if candlesticks are not the answer, then what is price action? Listen to the traders on television, expert traders, traders who trade for a living. Listen to what they say. They tell you every day what's important, and they virtually never mention a candlestick pattern. So what do traders talk about? If they're not talking about all these candlestick patterns that you see on the internet, What are they talking about? How are they making money? One of the most important things that they talk about is support and resistance. And that comes in many forms. Moving averages, channels. Here's the average price, right? They're interested to see how the market reacts to the average price. We're falling down strongly. And when it gets back to the average price, that's probably expensive. Traders will look to sell. It becomes resistance. Here we're rallying strongly. When it gets down near the average price over the past 20 bars, 100 bars, it reverses up, support. And they also look at channels. Here's a bear channel after a bull breakout, so it's probably a bull flag. Traders also spend a lot of time looking at prior highs and lows. The market rallied to this point and sold off. It broke strongly above it, came down near that point, and it's now support. It rallied again. It broke below it, tried to get above it again, failed. Tried to get above it again, failed. That high was resistance, and then support, and then resistance again. In this low, the market broke strongly below it. It tested it, could not get above it. It was resistance. Tried to get above it again, resistance. Tried to get above it again, resistance. Another thing that traders always talk about is how strong a trend is. For example, if the market's in a bull trend, you want to see higher lows. You want to see higher highs. And if you see that, traders are more inclined to buy for any reason. In a bear trend, they look at lower highs and they want to see lower lows. And if the market is going down, they're more inclined to sell until there's a clear reversal up. Here, a bear trend, strong bull breakout, higher low, big enough pattern for a major trend reversal, and it reversed into a bull trend. Bear channel, bear trend, bull channel, bull trend. There are two forces that are very important and they control all markets. First of all is context and momentum. Remember I said that context means all the bars to the left. Where is the support and resistance? I talk about this in a separate video on support and resistance. For example, we're falling here, and if you draw a line across these tops, you'll see that every time it gets near the line, it falls. Even if it gets above the line, it falls. Above the line, it falls. And prior highs and lows are important. We're in a bear trend, you're looking to sell. Selling pullbacks is a good thing to do. So if it gets near a trend line and reverses down, that's a good thing to sell. Near the trend line, reverses down. Near the trend line, place a stop order to go short just below the prior bar. And then look at this. Every time it gets near the prior low, it goes up. So there's support at prior lows. Traders will look to buy reversals up. When the market makes a new low, they'll place a stop order to buy above the high of the prior bar. These little green boxes are where they get in. Traders who look to sell at resistance and buy at support are value investors. They want to buy when it's cheap and sell when it's expensive. Now, I said there were two things. I said context and momentum. And momentum refers to the strength of the trend. And the video on breakouts talks a lot more about momentum. Now look at this. We're falling pretty strongly here, rallying pretty strongly here. When momentum is strong, traders want to trade in the direction of the momentum. So if it's falling strongly, traders should be looking to sell. You could sell even the close of this bar, betting that any reversal up will probably stay below that high and be followed by lower prices. And the same is true here. You could buy the close of this bar, knowing that there'll be at least a little bit more up. And here, it pulled back, but held above the bottom of the bull trend and starts to turn up again. So traders will buy on the reversal back up. So they'll buy the breakout or the pullback. Here, they'll sell the breakout or the pullback. They don't sell simply here. They sold all the way down, but you can even sell at the worst price and make money. The same with here. Traders don't all buy that close. A lot of them bought all the way up here. That's why we got this strong breakout. Everybody's buying. Look at here. The market's losing momentum. We have a couple bear bars, but they're small, followed by a bull bar, a bear bar with a tail, a small bear bar followed by a bull reversal bar. The momentum down is getting weak. Compare that to this. And traders are buying every low. Bulls are making money buying every low, betting that the trend will not fall that much further. The market is transitioning from a strong bear trend into a weak bear trend, and then possibly a trading range, double bottom, and then possibly even a bull trend. So the momentum is weakening, and traders start looking for reversal trades. For example, buy the reversal up. We have a double bottom, maybe a slightly lower low major trend reversal. We have a bear trend, strong bull breakout above the top of the bear channel, and then a test of the bear trend low and a reversal up, and a second and a third reversal up. So that is a reasonable reversal trade to take. I pay a lot of attention to early signs of strength. So we're in a bear trend, but look at this. We have 4 consecutive bull bars, 2 of them with very big bull bodies, all 4 closing near their highs. Bear trend, yes, but we have a sudden burst of buying, and that's a lot of strength on the part of the bulls, and I refer to that as buying pressure. So I pay attention to buying pressure. Here. We sold off strongly, but it reversed up strongly. The market is becoming more bullish. We're getting a lot of buying pressure. And on the way down, I look at selling pressure. We have a lot of bars down. Every bar, the high is below the high of the prior bar. The low is below the low of the prior bar. So we're trending down pretty strongly. Odds are, selling for any reason, we'll get at least a little bit more down. Traders also pay attention to the strength of the trend. I told you that in addition to risk and reward, they need to pay attention to probability. And a very important thing is trade management. Once they take a trade, they have to manage it correctly. To make money as a trader, candlestick patterns, that's not the answer. They're basically totally unnecessary. They can be a useful small piece of the big picture, but they're really not important. A lot of institutions trade off line charts. They don't care about the candlestick patterns. They know that the direction of the trend, the strength of the trend, support and resistance are far more important than candlestick patterns. So if you look at this line chart, are you thinking that a candlestick pattern would make it more bullish? Or are you saying, wow, this is going up really fast, higher lows, higher highs, I gotta buy. Candlestick pattern is not going to make it any more bullish. When you see this, you gotta buy. And a candlestick pattern will not help you. Now, I want to say a few things about indicators. When I first started trading, all the magazines had pictures that looked like this. They tried to stuff as many indicators onto the chart as possible to lead you to believe that if you buy their software that can create all of these indicators, you're going to get rich. That you'll have some big advantage that will allow you to make money. Does all of this stuff really help? If one indicator is good, is 2, 3, 4 better? Having 10, is that better? The answer is no. In fact, you can barely see the chart with all of these indicators all over the chart. Your eye is going to get focused onto the indicators, and you will not be paying attention to the chart. Here's the same chart with the indicators removed. I can see what's going on. The bulls are trying to break out. We have a big reversal bar. We're probably going to continue back down. Trading range breakout probably will fail. I'm looking to sell. 3 pushes down, a trading range breakout below. I'm looking to buy. A triangle, breakout, a small triangle inside of a bigger triangle. I'm probably going to sell. Strong bear trend, a bull reversal, probably going to fail. I'm looking to sell. A minor reversal, possible final flag, decent buy reversal bar, I'll look to buy. 50% pullback from the sell-off, I'm going to start looking to sell. Okay, we got a second entry short. We have a small double top here. I'm looking to sell. Small triangle, failed bull breakout. I'm going to bet that will continue down at least a little bit more. I'm looking to sell. Higher, low, major trend reversal. Bear trend, bull breakout, higher, low. The sell-off not all that strong. 2 legs down, 1 pullback, 2. I'm going to look to buy. And the indicators don't show me any of that. So for me, I personally prefer just to look at the charts and try to understand what the market is doing, and then I place trades based upon the price action. To me, I don't like indicators. I get stressed out. Constantly looking for reversals and trends. I'm constantly looking for breakouts and trading ranges, and that's the exact opposite of what I should be doing. This is a common thing that you see. Okay, look at this low and this low in the indicator. So we got a low, we have a higher low, we have a higher low. This is a divergence, this is a double divergence. And the websites will tell you, oh, you got a double divergence, you got to look to buy. Right? Yeah, we got lower prices, and then we have a higher oscillator. You have to buy. No, look at the bars. You're in a really tight bear channel with virtually no significant pullback. It's far easier to make money selling. So even though we got a divergence, here's another divergence. Prices going down, indicators going up, higher lows. It's crazy, right? And that's the single biggest problem with indicators for beginners. They look at the indicator for patterns. Oh, a divergence, I got to buy. And they don't look at the chart. When the market's in a small pullback bear trend, You can only make money selling, not buying. So indicators, it's an excuse to avoid thinking about the obvious. So buying in a strong bear trend, yes, it can work and you can make a fortune. But so the risk reward is great. So you buy here, your risk is here, very little money at risk. We could go up forever. So your reward is huge. However, what is the probability? The probability is extremely low. So you need much more than risk reward. One of the unfortunate things on television is traders constantly talk about risk and reward. They never talk about probability. But that's the flip side of risk reward. Whenever a trade has excellent risk reward, in other words, small risk, great reward, it also has very low probability because there has to be a reason for an institution to take the other side. So if you get great risk reward, guess what? The institution taking the other side of your trade has high probability. He's probably going to make money. Every now and then, you'll make a lot of money, but most of the time, you're going to lose. So you keep getting these small losses. Your indicators are telling you to buy, 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 buy. Buy, you lose. You buy, you lose. You buy, you lose. And you're not losing much. Remember, your risk is small. However, you can bleed to death from 1,000 paper cuts. Those small losses add up. You have to be patient. There's a lot to learn. That's why there are so many videos in this course. I'm trying to teach you everything that you need to know to be a successful trader. And there are no shortcuts. Indicators are not a shortcut. Candlestick patterns are not a shortcut. And trading is never going to be easy because you're competing against extremely smart, hardworking people who have been doing this for years. And they don't want to give you a penny. They want to take every penny that they can get, and that's their job. That's what they should do. That's my job, and that's what I try to do every day. But even though it's hard, I really enjoy the challenge. Well, what type of chart? Look at this chart. Okay, this is the euro versus the yen. It's a monthly chart. But when you look at it, if you didn't look at the time axis, you would say, oh, maybe that's a 5-minute chart. Maybe it's a 1-minute chart. Maybe it's a 60-minute chart. It's a monthly chart. And the point I'm trying to make is some traders do not want to trade intraday. And they'll trade daily charts or weekly charts or monthly charts. It doesn't matter. The process is still the same. The market's going up. Traders are looking to buy pullbacks, or they'll even buy breakouts. Okay, we're trying to top. Traders will start to sell. And this process is the same. It doesn't matter what the time frame is. All markets are fractal. Bigger patterns are made up of smaller patterns. Smaller patterns are parts of bigger patterns. It's all the same thing. If you do trade a monthly chart, the bars are very big, so the stop is very far away. You have to trade very small to make sure that the risk on your trade is no bigger than the risk on any other trade. In this video, I talked about candlestick patterns and how they are not particularly helpful. I also discussed what professional traders talk about. And as I said, they talk much more about support and resistance and momentum, the strength of trends, than they do about candlestick patterns. They virtually never talk about candlestick patterns. And I also talked about indicators and how it's very easy to get overly dependent upon them. And if you use them, you'll find that they probably don't help you make any money. I don't have a problem with somebody using indicators if they're making money and if they're happy. But if you're not making money and if you're stressed out using them, then I would get rid of them and just look at the charts. And if you look on television, you rarely ever see anybody putting an indicator up. And that's because most professional traders don't pay attention to them. They pay attention to the price action. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the final video on chart basics and price action. This is Al Brooks. Thank you for watching the Brooks Trading course. This series of videos is on the basics of Forex trading. I'm first going to talk about what exactly is the Forex market. I will then talk about the Forex sessions, different times around the world. And finally, I'll talk about leverage and fundamentals. Forex, the term itself, is a contraction for foreign exchange. And currencies trade against one another in pairs. For example, if you go to Paris on a vacation, you go to a foreign exchange shop, you give them dollars, they give you euros. Now, I mentioned the term Forex means foreign exchange. But the reality is there's no exchange. There's no New York Stock Exchange or NASDAQ. The market is an off-exchange market. It's not regulated by anybody. You simply go into any little shop around the world, and there are thousands and thousands of them, and you give them dollars, they give you euro. You give them euros, they give you yen. Whatever you want, they will make the exchange for you. and they do not report to any centralized market, and they are not regulated. No one sees your trade. No one knows what anyone else's trade is. And because of that, there's no last trade. If you trade Apple on the NASDAQ, everyone agrees on the last trade. The NASDAQ reports it. But in the Forex market, there are hundreds of trades taking place at any one time in hundreds of locations all over the world. And which one is the last trade? Nobody knows. Prices at one bank or one brokerage firm are going to be different from those at another bank or another brokerage firm because they don't share information with one another. As a result, there's also no volume on the bars. Your bank may report the volume that's taking place at that particular bank, but they have no idea of the volume taking place at 100 other banks. So the volume that you see, for example, some brokerage houses provide volume on their charts from their bank. It's not reliable because it doesn't give you any idea of what all the other banks are doing. And your broker, even if it's a big broker, might be trading 1% of the total volume that's taking place. Forex market, thousands of places all over the world that do it. Here's 1 square mile in Manhattan, and every one of these little red dots, big dots, they're all foreign exchange centers. And none of them reports to any central agency. Every bank, every broker, every little exchange office like this, they create their own market. They'll buy if you want to sell, they'll sell if you want to buy. And it's also the biggest trading market in the world, bigger than the stock market, bigger than the bond markets. So who trades foreign exchange markets? Well, you often hear about huge speculators like George Soros making billions of dollars betting against the British pound. There are speculators, major hedge funds, large individual traders. There are also international businesses. If you're Apple, you're buying equipment from China, you have to pay them. You're not going to pay them with dollars. And if China is making goods in China and they're selling the goods in the United States, they have to transfer yuan into dollars. And that's true of anything. If you go to Paris and you want to buy a salad, you have to give them euros. You cannot give them dollars. So you have to go to some exchange place to trade your dollars into euros. And when you come back home, you go to another foreign exchange place, you give them euros, they give you dollars. You can do it at the airport, and the airport knows that you're somewhat desperate to make the trade. And as a result, the spread between what you want to give them and what they want from you is huge. Plus, they often have fees. So the cost of a transaction at an airport might be 10%. So if you give them $100 and you convert it into euros, and then you immediately sell the euros back to them, you'll get maybe $90. Even though the market has not changed, they will keep 10% of the transaction. Tourists might transact hundreds of dollars at a time, but that's not true of governments, businesses, and speculators. They exchange millions to billions of dollars at a time, and they don't want to be paying a 10% transaction fee. They need a very tiny transaction costs, and the foreign exchange markets allow that. In general, the transaction fees, whatever, if there's a brokerage fee, the spread, it's usually less than 1%. And if you're an institution, I'm sure you're paying far less than 1% on every transaction. Now, why would anyone want to trade the Forex markets? Well, there are several good reasons for beginners. First of all, the account size is small. Compare that to the size required to trade stocks, options, or futures. The Forex market brokers often allow you to open very small accounts. For example, here's one that allows you to open an account with $30. You can start with much less capital. Also, there's a tremendous profit potential. I've said that George Soros made billions of dollars in the currency markets. Well, here's a story about Paul Rotter. And when he was a young man, he was supposedly making $60 million a year for many years. He was trading German bonds, but he was also trading Forex markets. The potential for profit is huge. Also, he started out as an individual trader, just like you, just like me. If you are going to be trading Forex markets, you pretty much have to pick what time of day that you're going to trade. You don't want to be trading in the afternoon one day, in the middle of the night another day. The Forex markets are open pretty much 24 hours a day. They're open on Sundays at 2 o'clock in the afternoon, Pacific time, California time where I live. And they close Friday at 2 o'clock, California time. And then throughout the week, there are different sessions. Australia trades at certain hours, and then Tokyo, and then London, New York. And then it starts over again, 24 hours later, again in Sydney. Although the Forex markets are open 24 hours a day, most traders pick one session to trade. For example, California time, where I am, The Asia session starts about 3 o'clock in the afternoon and goes until midnight. The European session overlaps it a little bit. Sometimes it gets active around 11 o'clock at night, sometimes midnight, and it stays active until 7 o'clock in the morning. And the American session becomes active around 5 or 6 o'clock in the morning and then gets very quiet around 11 o'clock or noon. And the sessions overlap. You can see there's an overlap here between London and New York, and then overlap here between Sydney and Tokyo. Here is a chart of the euro versus the yen, a 5-minute chart. And this is the European session, and it stayed active until 5:30, 6:30 or so. And the US session began to get active at that time as well. Most traders pick one of the 3 sessions to trade. So for example, here's the US session. The bars are big, the market's moving. And then when it closes, this is what often happens. The market enters a very tight trading range. There's still trading taking place, but very difficult to make money. So most traders should not trade between the US session and the Asian session. The Asian session often overlaps the European session, but a lot of times it also goes quiet in a tight trading range. Again, not worth trading. Great liquidity when the market is active like this, much less liquidity in between sessions. In any case, if you're trading the US session, the Asian session, the European session, you're never going to get too big. And slippage is not really going to be a problem. There's so much money being traded that no matter how big you get, you're not going to be too big. You're not going to affect the prices. The US session almost always ends with a very tight range. The Asia session often ends with a tight range. It often overlaps the European session. Now, one of the advantages of trading Forex markets is leverage. As an individual trader, when you trade, you have to open an account with a broker. You're not going to go to a local foreign exchange shop and trade because you cannot make money because the transaction costs are 10%. You need transaction costs in the neighborhood of 1%. And to get that, you have to open an account with a broker. And every broker has a minimum margin requirement. It varies depending on which pair of currencies you're trading. And sometimes the margin requirement allows you to have 50 times leverage. And that means, for example, you may only need 2 or 3% to place a trade. If you want to place a $50,000 trade, you may only have to have $1,000 or $2,000 in cash to take the trade. Margins change. When a particular currency pair is having big ranges, the broker will increase the margin requirement. So instead of 50 times your account value, you may at times only be able to trade 20 times your account value. One of the advantages of Forex trading is the leverage. And a lot of brokers will often allow you to trade with 50 to 1 leverage. You only have to have $1 to control $50 worth of trading. So for example, if you want to trade $100,000 worth of dollar versus the yen, you can do it with an account size as small as $2,000. Now, if your account size is only $2,000, you don't want to be trading $100,000 worth of dollar yen because it would not take many losing trades before you lose your entire account. However, you can trade with a lot of leverage. So if you have a $2,000 account, you can certainly trade with 5 or 10 to 1 leverage. As an individual trader, I don't care at all about fundamental information. However, institutions pay a lot of attention to it. They read the Wall Street Journal, the Financial Times, they watch CNBC, they pay attention to international news, they pay attention to economic indicators, they pay attention to interest rate changes and differentials. And that's all nonsense as an individual trader. As an individual trader, that stuff is useless. As an individual trader, this is all I'm interested in. If the market's going up, I want to buy. And I don't care why it's going up. I don't care if there's some expert on television explaining what's going on. I don't care if there's an article in the Wall Street Journal. All I care is the market's going up. The only way I can make money is buying, so I'm going to buy. As a Forex trader, an individual trader, you're far better off just to look at charts and use price action to decide how to take trades, how to enter, and how to manage your trades, and totally ignore fundamentals. When I look at this chart, I know the fundamentals. Let's say this is the chart of the US dollar. When I look at this chart, the fundamentals are good for the dollar. I don't need to watch television to tell me that the fundamentals support the dollar and that the dollar should go higher. I just look at the chart, and that's all I need. whatever people are saying on television, whatever the Wall Street Journal is saying, totally useless to me as a trader. There are risks to Forex trading as well. The advantage of Forex trading, leverage, tight bid-ask spread, those are good things, but they also can be risks. Leverage, sometimes traders will take positions that are too big and just a few losses and they can wipe out their account. Also, some brokerage firms charge bid-ask spreads that are outrageous, especially on small accounts. And if the transaction cost is 3, 4, or 5%, it becomes virtually impossible to make money. And then there are other risks as well, international interest rates, international news. And then firms also make mistakes. I remember talking with many brokerage firms over the years, not so much now, but 10, 15, 20 years ago, 30 years ago, the stuff would happen and it would be the firm making a mistake. But when you set up your account with that firm, if you read the small print, it says they are not liable for mistakes. You are. So if they screw up, they don't pay, you pay. There's also a possibility in settlement, not so much if you're trading a Forex account with a broker, but if you're an institution, one side might not deliver. You give them a whole bunch of dollars and they're supposed to give you yen and they don't give you the yen. There's nothing you can do about it. But that's not a problem for individual traders. For a broker, pick some big reputable firm. Less chance of problems. The commissions are low or non-existent. The spread between the bid and the ask is small. And they usually have a pretty good trading platform. Also, they usually allow you to have positions in multiple pairs at one time. Back in 2015, there were a couple of Reader's Choice Awards winners, Interactive Brokers, FXCM, but there was a rule that changed a few years ago, and it restricted leverage on firms that offer trading in other products beyond Forex markets. For example, TradeStation no longer allows Forex trading because the margin requirements apparently went way, way up. They could not use the traditional Forex margin requirements that purely Forex firms were doing, so TradeStation stopped offering Forex trading. And Interactive Brokers had a similar situation. Now they have a cap on the biggest position size you can take as an individual trader. I don't know if it's 30,000 units, but anyway, it's small, and it's so small that individual traders no longer trade Forex with Interactive Brokers. They still have institutional accounts, but you need, I think, $1 million Forex account, $1 million US dollars in the account to trade it. So they're pretty much out of the Forex trading business. Yet firms that only trade Forex do not have that same restriction. So FXCM, for example, is a good choice. There are other good choices as well. Popular trading platforms, MetaTrader is popular, and so is NinjaTrader. In this video, I talked briefly about what the Forex market is. I then talked about the sessions and how they overlap. It's basically a 24-hour market. And finally, I talked about leverage and how fundamentals are not at all helpful to an individual trader. Just look at the charts. The charts tell you all that you need to know. This is Al Brooks, and thank you for watching the Brooks Trading course. This is the first of several videos on the basics of Forex trading. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second in the series of videos about Forex basics. I'm first going to be talking about the risks involved with Forex trading, the costs involved, and brokers. Next, I'll talk about Forex symbols, how to create them and what they mean. And finally, I'll talk about the types of quotes that take place in the Forex markets. Most firms do not charge commissions in Forex tradings. They make their money off the bid-ask spread. And in some firms, the spread is fairly wide. For example, a 2-pip spread or a 3-pip spread is very difficult to make money if the transaction costs are too high. So if you're trading 100,000 units of the euro versus the dollar, and there's a 2-pip bid-ask spread, it costs you $20 to buy and $20 to sell 100,000 units. And some brokers, the transaction costs are very high, makes it very difficult to make money. Other brokers, the transaction costs are low, much easier to make money. When you're trading Forex, make sure to trade at one of the popular big name brokers because chances are they will have tight bid-ask spreads and it will be easier for you to make money. I'm using Interactive Brokers here because they are a firm that charges commissions. So for example, on any trade, they charge a $2 commission plus 0.2 of a pip. If you're trading 100,000 units, that is $2 plus $2, a $4 commission. Plus you have to pay the bid-ask spread. Their bid-ask spread is tight, let's say a half a pip, so that's $5. That means you have to pay the commission, $4, plus the spread, $5, and it costs you $9 to buy and $9 to sell. TradeStation no longer offers Forex trading, but I'm using them as an example of a firm that has a very wide bid-ask spread. So for example, if you look at their quote screen, the bid-ask spread on the euro versus the dollar is 1.7 pips. They did not charge commissions, but they made their money by having a very big bid-ask spread. Total cost of the trade, 1.7 pips. Interactive Brokers, on the other hand, if you look at the spread, it's very tight. It's only a half of a pip, but they also charge commissions of about half of a pip. So your total cost is 1 pip. This is a comparison that shows some firms, even if they charge commissions, they can be cheaper than firms that charge no commission if the bid-ask spread is sufficiently wide. Again, when you choose your firm, make sure to pick a reputable, big, popular firm, because chances are your transaction cost will be the smallest. Now, the goal of Forex trading, obviously, to make money. If you're buying 100,000 units of the euro versus the dollar, so you're buying the euro and you're selling the dollar, you're expecting the price to go up. Maybe you buy here and then you sell when it tries to reverse down here, and you make 216 pips profit. And on 100,000 units, that's about $2,000 profit. The trades take place in the cash Forex market. You're buying one currency, you're selling another currency, and there are countless pairs to choose from. And this is an example, 60-minute chart, 100,000 units of the euro versus the dollar. I want to talk a little bit about Forex symbols. For example, I talked about the euro versus the dollar. And if you're buying 100,000 units of the euro versus the dollar, the symbol is made of two parts, euro and dollar. The red, the euro, the first currency, is called the base currency. It's the currency you are buying or selling. So if you're buying 100,000 units of the euro versus the dollar, you're buying 100,000 units of the euro. And the second name in the pair is the quote currency. It's also called the secondary currency or the terms currency, and it's the currency price being quoted. I know this sounds confusing, but if you're interested in the basics of terminology, that's what you have to deal with. Nicknames, this is, I think, silly. Traders don't use this stuff. Sometimes on television, you'll see somebody talk about, oh, I bought the cable, which is the British pound versus the dollar, or I sold the gopher, the dollar versus the yen. It's kind of like a secret handshake, knowing what the terms are, but nobody uses them. Let me go back to that 60-minute chart of the euro versus the dollar. Okay, the quote currency is the second name, which is the dollar. In this particular example, if you buy 100,000 units of the euro versus the dollar at this price level, which is right here, 1.1278, what that means is it took $1.1278 to buy 1 euro. So 100,000 unit position is 100,000 units divided by that exchange rate, and that means you're buying 88,000 euros. And it fluctuates constantly. This is at that instant, that's what the price is. Now, let's talk about the euro versus the yen. It might be quoted at 123.02 bid, 03 ask. If you want to buy the yen, you got to pay the higher price, the ask. So you'll be paying 03, and you're paying 123.03 yen to buy 1 euro. And if you're selling, you pay the lower price. Anytime you sell, you pay the lower price. Anytime you buy, you pay the higher price. And that's how the bank makes its money. The broker and the bank make their money. And that difference is the spread, the bid-ask spread, or simply the spread. Let's say you sold 100,000 units of the euro versus the yen. So you're selling the euro and you're buying the yen. And then you exit down here with 37 pips profit. Since there are $9.01 per pip, then you made $333 in profit. I'll talk about the math later on in the videos. A big problem with Forex markets less so today, but in the past it was a big problem, is that the firms cheat. They rig the markets. They can front run orders when the orders are big enough to move the markets. And they can collude with other firms to place large orders to move the markets. They can buy information from corrupt friends in government before news comes out. They can trade on inside information. Much less a problem in the United States, and much less a problem internationally now. The governments are cracking down. There's a thing in Forex trading called the London 4 p.m. fix, and in the past it was a way that firms could cheat. What happened was they would set the prices 30 seconds before and after 4 o'clock London time, and some firms would collude to make the price too high or too low. They would place huge trades, and then if the price was too high, for example, they would quickly sell and make a profit. If they could drive the price down too low, they would buy and make a profit. That tiny window allowed firms to submit huge orders, a lot of orders, very quickly before anyone has a chance to react. They could fix the price too high, and then they could sell and make a profit. And that little window, that 1 minute window now is 5 minutes. It begins 2.5 minutes before 4 o'clock and it ends 2.5 minutes after 4 o'clock. Firms might still collude to move the market briefly and make profits, but it's much less of a problem and it has no effect on us. As traders, I would not worry about firms, governments cheating. The markets are pretty honest and reliable at this point. I'm going to talk a little bit about quotes right now. In stocks and in the E-mini, you hear about ticks. Each little move up or down is a tick. And in the Forex markets, each little move up or down is a pip. And pip was the smallest price change, but it's no longer the case. For example, in the euro versus the dollar, here's a 1 minute chart. You got 1.1179. That fourth digit is the pip, so that's 9 pips. And in all of the markets, it would be called ticks. Every little move up and down is a tick. In the Forex market, it can go from 8 to 9 to 0 to 1, 2, 3. Each one of those little steps is a pip. And if it were a stock, it would be a tick. And the reason why I put smallest in quotes is because a lot of firms now have fractional pips, and they add 1 or 2 more digits. As traders, they're totally meaningless. They change so fast that you cannot even see them. Most Forex pairs have 4 decimal places, but the Japanese yen has 2 decimal places. So the dollar versus the yen, 2 decimal places. The euro versus the dollar, 4 decimal places. And most brokers now add an additional decimal place, a fractional pip, presumably to allow tighter bid-ask spreads. Here, 9 is the fractional pip, 4 is the pip. If it drops to 3, it dropped 1 pip. If it goes up to 6, it goes up 2 pips. And here in the euro versus the dollar, this is the fractional pip, and then the 9 is the pip digit. If 9 goes up to 0, the market went up 1 pip. I said most brokers provide quotes with fractional pips, and that's true with charts as well. I only pay attention to the 4 digits in most pairs, and then in the yen, I pay attention to the 2 digits. But the reality is most brokers add a digit, a fractional pip, and they change so fast I can't even see them, and I don't pay any attention to them when I'm trading. Euro versus the dollar, the 4th digit is the pip, and then the 5th digit or 6th are fractional pips. And in the yen, the 2nd digit is the pip, and the 3rd is a fractional pip. Sometimes they have a 4th as well. When traders compare how they're doing with one another, they talk about the number of pips made or lost per day. They usually do not talk about their position size. So one trader might be trading 10,000 units. Another trader might be trading 1 million units or 5 million units. And traders don't like to say, I made $7,000 today, or I made $26 today. Instead, they tend to talk in terms of pips. How many pips did they make today? How many pips did they lose today? Traders want privacy. They don't want anyone to know how much they're making or how much they're losing. However, if you talk in terms of pips, you made 26 pips profit today, or the other person made 13 pips profit today. It allows you to compare how well one trader is doing compared to another. Here we have a strong bear breakout, strong follow through. Let's say a trader sells that close, and then later in the session, the trader buys back down here, and they made 25 pips profit. So they sold at 1.0940, and then they bought back at 15, and that's a 25 pips profit. Regardless of their position size, whether they traded 10,000 units or a million units, they made 25 pips profit. If a trader bought the euro versus the dollar at 1.3124, you can add the fractional pip over here, 6, and then sold it here, he made 2.1 pips profit. And most traders ignore the fractional pip. So instead of saying I made 2.1 pips profit, the trader would say I made 2 pips. And then if he adds up all of his pips won or lost in the different crosses, the different pairs during the day, so he made 31.4 pips in the dollar yen. He lost 8.8 pips in the euro versus the Australian dollar. If you add all of that up, he made 37.4 pips, and he will say, oh, I made 37 pips today. In this video, I talked about the risks of trading, the costs of trading, and differences among the brokers. I talked about how the Forex pairs symbols are constructed, and I also talked about the types of quotes, pips, and fractional pips. This is Al Brooks. Thank you for watching the Brooks Trading course. And this particular video is the second of 5 videos in the Forex Basics. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third in the series of videos on Forex Basics. First, I want to talk about the value of a pip. Then I want to talk about Forex workspaces that are offered by different brokers. And finally, I want to talk a little bit about futures compared to Forex trading. So how much is a pip worth? Let's say you take a trade with 10,000 units. 1 pip in that case is about $1. And if you do a search online, you'll find that there are a lot of free pip calculators that allow you to plug in information about your trade and convert the information into dollars to find out how many dollars you made or lost. If you're an American trader, you only care about dollars. You don't care about pips. You'll often hear traders say that the standard size is 100,000 units. And when that's the case, 1 pip is $10. Standard does not mean everybody trades 100,000 units. In fact, most traders probably do not trade 100,000 units. In the Forex market, there are so many different participants. Every imaginable size is traded. Okay, let's talk about the euro versus the dollar. And 1 pip in the euro versus dollar pair is quoted as 0.0001 US dollars. If you're trading 100,000 units, then 1 pip is 100,000 times that, or $10. Because the US dollar is the second name in the pair, the quote is in dollars, and your profit or loss is in dollars as well. So what happens with something else, like the dollar yen? The yen is the second part of the pair, so the quotes are in yen. If you're trading 100,000 units, 1 pip in that case is 1,000 yen. So 100,000 units times 1 pip is 1,000 yen. So 1,000 yen is 1 pip. And whatever profit or loss you make, it's in yen. And if you have an American broker, at the end of the session, it's converted into dollars. If the dollar yen cross rate is 104.32 at the end of the session, 1,000 yen is $9.59, and 1 pip in that particular case is $9.59. Let's say we have 100,000 units of the dollar yen, and the dollar yen is trading at 104.32. Then there are 104.32 yen per dollar. 2 is the pip digit, the second digit. So there are 10,432 pips per dollar, and therefore 1 pip is 1 divided by 10,000, and it comes out to this many dollars per unit. If you're trading 100,000 units, 1 pip is about $10. Standard trade size, 100,000 units, and 1 pip is 100,000 times that decimal, and it comes out to $9.59, or about $10. So in general, if you're trading 100,000 units, I always think of 1 pip as being about $10. Every broker has software that allows you to trade. This is an example from TradeStation. They no longer offer Forex trading. It's a common type of example with quote screen on the left with all the different popular Forex pairs and then charts on the right. Here is from Interactive Brokers. This is another common way to present quotes. They show the bid and the ask for a variety of pairs, and you can put down any pairs that you want on the screen and you can reorganize them, reorder them. Interactive Brokers also has a price ladder, and a lot of traders like to enter orders on the price ladder. And then also you can put a chart up. You can place trades on the chart. Now, to place a trade, you need a market. You could go to a little kiosk down the street that is a foreign exchange center, but the transaction cost will be so great, it's impossible to make money. The advantage of a Forex market is it allows you to buy or sell at any time. And whenever you want to place a trade, you need somebody else to take the opposite side. And it's the broker's job to create that market for you. Whenever you want to buy or whenever you want to sell, he's always willing to do the opposite. If you're buying, the broker or his bank will sell. If you want to sell, the broker or his bank will buy. Now, there are two types of Forex quotes. During the trading day, there's the bid and the ask, which is very important to traders. But after the session closes, there's a last price, and it's used by the brokers to make adjustments after the session ends. Here's the ask, there's the bid. The ask is always the higher price. It's where the broker is willing to sell if you want to buy. So he's going to charge you more. And the bid is always the lower price. It's the price that the broker is willing to give you if you want to sell. You buy at the ask, the higher price. He sells at the ask, the higher price. You sell at the bid, the lower price, and that's the price he will buy from you. The difference between the two prices is the spread. Here's the bid-ask spread. Here's the ask, you subtract the bid, and this is the spread. Here the spread is 1.4 pips. In general, you're going to lose at least a pip or so on every buy or sell. Some brokers have tighter spreads, half a pip. Some brokers have wider spreads, 1.5 to even 3 pips. And the broker, that's where he makes his profit. He keeps that bid-ask spread. And that is the reason why he is willing to do the transaction. He's always going to be willing to buy from you when you want to sell. He's always going to be willing to sell to you when you want to buy, because he makes money on every transaction. Okay, here's an example. Here's the bid, 47, and here's the ask, 61, and the spread is 1.4 pips. He will buy from you at 447, and he will sell to you higher at 61. So he makes 1 pip or more on every trade. In this particular trade, if you sold to him, he made 1.4 pips. If you bought from him, he made 1.4 pips. Okay, example, 100,000 units of the euro versus the dollar. Here's the bid, here's the ask. The bid at 47 is the price you pay if you want to sell, and the ask, the higher price, is the price you have to pay if you want to buy. The broker's profit is the bid-ask spread, 1.4 pips, or about $14. 100,000 units times 1.4 pips, $14. You can't ignore the spread. It's a major part of trading. In general, you're going to lose about a pip, sometimes more, on every transaction. And that means if you're trading 100,000 units of the euro versus the dollar, you're going to lose at least $10 on every trade. So you have to make more than $10 just to break even. For years, traders wanting to trade currencies did so in the futures market. But now, most trading takes place in the Forex market. On the left, I have the euro versus the dollar 5-minute chart. On the right, I have the euro futures contract. You can see they're virtually identical. Because they're identical, you can trade the futures market, or you can trade the euro versus the dollar Forex market. The advantage of the Forex market, one of the big advantages, is that you can trade tiny positions. You can trade with very small accounts. Institutions prefer trading the Forex market to the futures market because of the flexibility. Also, they don't like to be monitored. They want privacy. They don't want regulation, so they avoid exchanges. And the transaction costs are low. And as I said, if you look at the two charts, the charts are virtually identical. But a futures trader needs a bigger account because the margin is always going to be at least $2,000, $3,000, $4,000 to trade one contract. Volume is still very good. So in this particular day, this big bear breakout had a 5-minute bar with 37,000 contracts, which is huge volume. It's not like futures have such thin volume that you should not trade them. The volume is still huge, so the bid-ask spread is usually one tick. Just like if you're trading Forex markets, the bid-ask spread is usually 1 pip or around 1 pip. If you're trading futures contracts, the bid-ask spread is usually 1 tick, $12.50 for a Euro futures contract, and the commission is about $5 round turn on top of the spread. So let's say you're trading at this particular price. You got 1.24 is 12,400 ticks at $12.50 a tick times 12,400 ticks. So the value of this Euro futures contract is $155,000. Every contract is worth $155,000. Now instead, let's look at the euro versus the dollar. If you trade 100,000 units, it's $124,000, which is pretty close to the same as one futures contract. 100,000 units of the euro versus the dollar is about the same size in terms of dollars as is a single euro futures contract. Now, one futures contract, one euro futures contract, the minimum cost per trade is the bid-ask spread, 1 tick, plus a commission, about $15. Now, the minimum cost, if you're trading 100,000 euro versus the dollar Forex units, the minimum cost is the bid-ask spread, which is about a pip, or about $10. Sometimes it's more. So the cost is comparable. The spread, you cannot ignore it. On the very popular contracts like the euro versus the dollar, or contracts involving the yen, the spreads tend to be fairly tight. But on less traded pairs, for example, like the British pound versus the New Zealand dollar, the spread can be 10 pips or more. Here, the bid-ask spread is 11 pips. If you're trading 100,000 units, the effective commission is still only about $7 per trade because of the price of the contract, 2.1210. So even with the very big spread, that still comes out to a transaction cost of $7 each way. In this video, I talked about the value of a pip. I talked about the different types of Forex workspaces that the brokers offer to you. And then finally, I talked about whether traders should trade the euro futures or the euro versus the dollar Forex markets. And you can trade either, but there's a big move from the futures market to the Forex markets. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on Forex basics. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on Forex basics. The first important point I make is that charts are not exactly what they appear to be, and you should assume that they are good approximations of what's actually taking place, but they are not exact. Finally, I'm going to be talking about scalping and swing trades. When I say that Forex charts are only approximate, one of the things that I mean is that if you have a chart on your computer and you're using one broker and somebody else has a chart on his computer using another broker, the prices are not necessarily the same. Different brokers use different banks. Some brokers use many banks. Even though arbitrage traders keep the prices relatively tight so that the difference never gets very far from one bank to another, the charts are slightly different for each broker and each bank because the charts only show the trades from your particular broker. For example, this top chart is from Interactive Brokers, IB, and you can see the red 5 here. That is the current last trade on this 5-minute bar. And this is the identical time, but a chart from the FXCM broker, and you can see the last trade was 1 pip lower. There are actually several ways to construct a chart. Given that there's no last trade, brokers have to use something else to construct charts. And they can have the chart constructed entirely on bid prices. They can have it constructed entirely upon ask prices. They can have a combination of bid and ask, and they can also use the midpoint of the bid and ask. Brokers have several options on how to construct charts. The most common charts are either based upon the inside bid, which is more common, and then the inside asking price. For example, here are two charts. The prices are actually slightly different. The bottom of this black rectangle on this bar is the final, most recent trade. Right below it, 1 pip below, there are orders wanting to buy there. And a pip below that, there are other orders bidding there. A pip below that, other orders bidding there. A pip above that most recent price, there are traders asking to sell there. And then higher, other asks, other asks, other asks. The lowest ask above the current price is the inside ask, and the highest bid right below the most recent price is the inside bid. This chart is based upon inside bids, and this chart is based upon inside asks. So in this particular chart, the high is 19 pips, 1.1319. This is the euro versus the dollar, and this chart is based upon the inside bid, which is the default for FXCM. And then on this lower chart, the chart's based upon the inside ask, and the high is 1.5 pips higher. The ask is always higher than the bid. Some brokers on their symbol will put a point A next to the symbol. TradeStation used to do that to show that it's an ask chart rather than a bid chart. Interactive brokers, they base their charts on either the midpoint of the bid and ask. Here is an example of a chart based upon the midpoint of the bid and ask. That's their default chart. They carry it out to 6 decimal places. 4 is the pip, and then they have 2 more decimal places beyond that. Most traders cannot trade those last 2 decimal places because the price moves too fast. The low of that bar right here is 6 decimal places as well. And then they also create charts based upon the minimum bid and the maximum ask. The bar is bigger because it's not using a midpoint, it's using the bid and ask. And the high of this chart is here at 16.5 pips, and here is 14.5 pips. The low of this bar is 1.1312.5. The low of this bar is 1.131375. The charts are not going to be exact, even with one broker, because some traders will be looking at the charts constructed this way, other traders will be looking at charts constructed another way. Now, there's something that's interesting about Forex charts that is different from other types of charts, stock market charts and futures charts. Now, I said that the default for FXCM charts is that they only show bids, not actual trades and not the ask. And because of that, buys, which always get filled at the ask, can be above the high of the bar. So you can get filled on a long above the high of the bar. If you're trying to buy, you're going to get filled at the ask. And the ask is always above the bid, and the high of this bar is based upon the bid because every price on the chart is based upon the bid. You might get filled on a buy order above the high of the bar, and your trade might not even be on the chart. Remember, everything in this chart is based upon the bid. But when you buy, you get filled on the ask, which is always higher. You can get filled right here, above the high of that bar, and your trade might not even be on the chart. Likewise, if you place a limit order to buy here, you might not get filled here. Buy orders are filled at the ask, which is above the bid, and therefore above the low of the bar. You only get filled if the ask falls below the buy order. Here, you place an order to buy. The market drops below your order, but you don't necessarily get filled. Remember, these are only bids. The entire chart is only bids. So, yes, the low of this bar is the lowest inside bid during that 5-minute period. That does not mean that a trade actually took place there. You can place a limit order to buy here. You can see the bar dip below your price, and you do not get filled. If it was a stock chart, you would get filled. But because this chart is based only on bids, you're not necessarily going to get filled. And you have the opposite problem if you choose instead to have your charts based upon the ask. Your sell trade may not be on the chart. FXCM allows you to create charts showing only asks. So, for example, here's a chart, and every price on this chart is ask only, not bid. And if you're selling, you get filled at the bid, not the ask. You can get filled below the low of a bar. So, for example, you could get filled selling below the low of this bar, and the bar never gets down to your price, even though the trade took place. This chart does not show trades, it only shows asks. And likewise, right here. Let's say you place a limit order to sell, and the bar goes a little bit above your limit order. If that was a stock chart or a futures chart, you'd get filled. Your short order would be filled. However, sell orders are filled at the bid, which is below the ask, and therefore below the high of the bar. And you only get filled if the bid goes above the sell order. That's just something you have to deal with when you're trading with Forex markets, especially if you're a scalper, where every little pip matters. You should just assume that the charts are approximate and never perfect. Don't worry if it looks like your order should be filled and it's not filled. If you're worried and you really think you should have been filled, you can call your broker. Chances are your broker will do nothing. And they'll say, if you read the fine print when you signed up for your account, they are on a not held basis. Anything that goes wrong, it's your problem. I want to talk a little bit about scalping and swing trading. There's no clear definition of a scalp versus a swing trade. And in general, if a trade lasts 1 to 5 bars and there are no pullbacks, or you allow only a minimum pullback, it's a scalp. And a lot of Forex traders don't even use the term scalp. Everything is a trade. So it does not matter if you get out with a 5 pip profit or an 11 pip loss. A lot of Forex traders just say it's a trade. They don't say it's a scalp. In general, when traders do use the term scalp, they're talking about trading smaller time frame charts, not hourly charts. Usually, they're trying to make 10 to 50 pips profit, and any trade more than that, they'll call just a trade. For example, let's say you buy this bull bar, you buy right above this bull bar betting on a failed bear breakout, but you're expecting the market to continue mostly sideways. So you're not looking for a big trade, you're looking for a quick profit. And let's say you exit right here with a 10 pips profit. 1 bar later, 15 minutes later, 10 minutes later, that is a scalp. A swing trader buying this trade would not get out here, he would hold, but then at some point he's seeing that the trade is not going very far, and now we're getting near the end of the session, 11 o'clock, 12 o'clock California time, and he might get out here. Even though he only made 18 pips profit instead of 50 pips or 100 pips, and the market did not go up much at all from the scalp exit, this person's still possibly a swing trader because he took the trade with the intention of holding it for a swing. Now, let's say we have this. We have a double bottom after a bull breakout, so maybe it's a double bottom bull flag. It certainly is, but maybe it's also a double bottom higher low major trend reversal. We don't know what came before. But in any case, we have a strong reversal up, 4 consecutive bull bars, and then a tight trading range. They might buy above this bull bar, especially since there was a bull bar here. So they're buying a double bottom bull flag. Scalper might get out here, might get out on this reversal down, a failed breakout above this high. And so he might get out with 10 or 20 pips. A swing trader will hold as long as he believes his premise is still valid. And here, the end of the Asia session, he might get out below 1 or 2 of these bear bars. We have a bear II, 3 or 4 pushes up, 1, 2, 3, and then larger, 1, 2, 3, larger, 1 or 1, 2, 3. A nested wedge, and end of the session, the bars are getting small, becoming dojis, and then we have a bear II. So the swing trader would get out here, and he made 26 pips profit, more than a 10 pip scalp, and it's not quite 50 pips or 100 pips, but he held the trade for more than 4 or 5 bars, and he was willing to hold through repeated reversal attempts, and he held until he felt that his premise was no longer valid, or that the session was going to end. Those are characteristics of swing trading. This is a 60-minute chart, and on a 5 or 15-minute chart, a scalp generally is about 10 pips, 20 pips, maybe sometimes 40 pips. But on a 60-minute chart, you can also take a brief trade, hold it for 1, 2, 3, 4, 5 bars, and you can call it a scalp. If you do call it a scalp, on a 60-minute chart, you're probably trading for 20 to 50 pips. So let's say here, we have a triangle or a tight trading range, and then we have a breakout and a follow-through bar. A decent breakout bar closed below the low of the past 30 bars maybe, and then another bar closing on its low. At this point, the probability of some kind of a move down, probably a measured move down at a minimum, measured move based upon the height of that range, traders will conclude the market is always in short, that it's probably going lower. So let's say you sold the close of this follow-through bar. And then you see this sell climax bar, and you wonder, well, maybe that's the end of it, and you took your profit. Maybe you placed a limit order to scalp out with 20 pips, arguing that we're not getting consecutive big bear bars. This is a pair of bear bars, but they're not particularly big. So maybe this is bear leg in a trading range, maybe a bear leg in a bear channel that will soon reverse up. So you're just not confident that it's going to go far. Maybe you place a limit order to get out 20 pips lower, and you get filled here. You're trading the 60-minute chart right here, and you get out with 20 pips. You get out 2 bars after you entered, not many bars. You did not allow any pullbacks, and you did not hold until there was a clear reason to believe that your premise was wrong. Right? Those are characteristics of a scalp. On the other hand, let's say you held, and then we started to enter a tight trading range here, and you're wondering, maybe it's the end of the Asian session. Maybe we'll reverse up. Who knows? But the market is losing momentum, the end of the Asian session. So maybe you get out above this bar. We have a high 2 buy. There's a high 1. Here's a high 2. If you did that, you would be getting out with 49 pips. And I would call that a swing trade. First of all, because you're around 50 pips. Second, you held for a lot of bars. Third, you held through a reversal attempt. And fourth, you held as long as the premise remained valid, and you only exited when you thought the premise may no longer be valid. In this video, I made the point that charts are only approximate, Forex charts are only approximate, very different from stock market charts and futures charts. And I also talked about the difference between a swing trade and a scalp. A scalp, in general, you're going to exit in 1 to 5 bars. If you allow a pullback, you only allow a small, brief pullback. In a swing trade, you are willing to hold onto the trade for as long as your premise remains valid. That could be 1 bar, it could be 30, 40 bars. And you'll hold through many reversal attempts as long as none is strong enough to change your premise. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on Forex Basics. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on Forex Basics. In this video, I'm going to be talking about the margins and how you can trade greatly levered positions. And then I'm also going to be talking about profit and loss. A lot of what's in this video is not important in terms of trading, but you have to have some familiarity with some of it. And what a margin is simply a good faith deposit that allows you to open a position. It's not a fee, it's not a commission. It's calculated on the base currency. So for example, if you're trading the euro versus dollar pair, the margin is 2% of the euro if the broker says your margin is 2%. What that means is for every 10 euros in your account, you can trade up to 500 euros in a position. And this is because although the charts look like they move a lot, on a percentage basis, Forex charts do not move much at all. Here's an example. Let's say you bought 100,000 of the dollar versus the yen. And let's say your fill price is 104.041. Margin is 2% of the base currency, in this case, the dollar. And if you're trading 100,000 units, $100,000, 2% of 100,000 is $2,000. So if you had $2,000 in your account and your broker was allowing you to trade with a 50-to-1 leverage, 50-to-1 margin, a 2% margin, then your $2,000 would allow you to buy $100,000 yen. Here's an example with the euro versus the dollar. And let's say you wanted to buy 100,000 units of the euro versus the dollar. And let's say your fill price was here, 1.31275. And let's say your broker currently is allowing you to trade with only a 2% margin. That's 2% of the base currency, which is the euro, the first of the two terms. 100,000 units times $1.31275 per euro, okay, equals $131,275. So a 2% margin, if you have a US brokerage account, 2% of that is about $2,600. If you want to trade 100,000 euro versus the dollar, you need at least $2,600 in your account. Every now and then, if a currency pair moves a lot, the broker will reduce the leverage and increase the margin. So instead of 2% margin, which allows you to trade 50-to-1, he might raise the margin to 4%. And if it's 4%, that means your position size can be 25 times greater than your money in your account. Now, margins are much smaller than for non-Forex markets, for example, the E-mini. And that's because, as I said earlier, Forex markets usually move less on a percentage basis. Now, 50 to 1, that means 1 out of 50. So 50 to 1 leverage is 1 out of 50, that's 2%. That means for every $200 in your account, you can trade a position that's $10,000 in value. Now, if you have a $200 account, you should not be trading $10,000. You should not be trading your entire account. However, theoretically, your broker would allow it. Now, I want to talk a little bit about profit and loss. And in this section of slides, I'm not going to say everything that is on each slide because it's boring and you don't need to know all the details to trade properly. But if you are curious about the details, you can pause the video and read the details. Okay, the profit or loss on a trade is based upon the quote currency, not the base currency. For example, here, euro versus the dollar is the quote currency, the euro is the base currency. At the end of the day, your trade is converted into your account currency at the end of the session. So if in the United States, it's going to be converted into dollars. In this particular case, since the dollar is the quote currency, there's no conversion to be made. On the other hand, let's say you're in the United States and you're trading the euro versus the yen cross. Your native account is US dollars. And at the end of the day, if you have a profit, it's in yen. Your broker will sell the yen at the bid into dollars. If you have a loss at the end of the day, the broker will buy yen at the ask in dollars to cover your loss. At the end of the day, there's a rollover that takes place. So a lot of brokers do this. I don't know if all brokers do this, but all positions, at least theoretically, are closed, and then they're opened automatically. They're rolled over for the next trading day, which begins just a few minutes later, except on a Friday. The next trading day is Sunday. There's a type of trade that you'll sometimes hear, but it really has nothing to do with you or me as traders, and that is a carry trade, and it's an interest rate trade. Traders buy a currency or a bond with a higher interest rate, and then they sell another currency or a bond with a lower interest rate. So they pay the lower interest rate, and then they collect the higher interest rate. And they're hoping that the currencies stay at around the same level, or that they do not move in the wrong way, because you don't want the value of the currency pair that you're hoping to profit on, the higher interest rate currency, you don't want it to drop drastically in value, because then whatever you're making on the higher interest rate, you're losing on the currency. So in a carry trade, the difference between the interest that you're collecting and the interest that you're paying is your profit. As I said, you'll hear the carry trade mentioned fairly regularly in reference to currency trading, but it has nothing to do with us. It's a long-term strategy that is used for institutions, not individuals. And again, as I said, it only works if the exchange rate is stable or if the Forex price moves in your direction. Another reason for me to bring up the carry trade is because it affects the roll price. For example, let's say you're long 100,000 units of the Australian dollar versus the Swiss franc. Okay? And let's say if the rate rolls at $3.20 for longs and minus $6.10 for shorts, then $3.20 is added to your account on the open of the next session. And if it's a Friday, you get 3 days worth of interest, $9.60. If you were short 100,000 units of the Australian dollar versus the Swiss franc, $6.10 would be debited. Now, this is what I was talking about when I started this video, that there's math here coming up, and you do not need to know any of this to be a Forex trader. However, if you're curious, I put the math here. And I'll just leave this slide on for a moment in case you're curious. If you're not curious, you can just advance. So here's an example of 100,000 units of the euro versus the dollar. If you sold at 131.81 and then you bought back at 1.3171, theoretically you have a 10 pip profit. 100,000 units, this is the math that takes you to the $100 profit. Another example, let's say you bought 100,000 units of the dollar versus the yen, and you bought it at 103.80, and you sold it at 104.11. And If you did the conversion, you had 31 pips profit, and that would be about a $300 profit. And one final example, 100,000 units of the euro versus the yen. If you bought it at 136.80 and sold it at 137.90, right, and you did the math, you'd have about $1,000 profit. Again, you're not going to sit down and do these calculations. There are profit calculators online, pip calculators online. A lot of the brokers provide them when you open your account, and this just gives you the math that's behind it. When you're trading, you got to be thinking about trading. You can't be doing all of these conversions. So in this video, I talked about margins and how they are small compared to when you trade stocks or futures. And I also talked a little bit about the math for profit and loss calculations. And it's nice to know the math, but it's not at all necessary to trade, and most traders don't pay any attention to the math. This is Al Brooks, and thank you for watching the Brooks Trading Course. This is the 5th and final video on Forex Basics.